Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to talk about a trending topic, a little bit controversial, which is the subject of the Trump tax return release. There's kind of a leak article, etc., from the New York Times. And so we're going to dive into that, a bunch of people's misconceptions, some things that you should take away from it, and kind of feelings for some future information. So we're going to go through it all. Look forward to hearing what you guys have as takeaways. Before we get started, if you guys want any assistance with learning about any of these sorts of subjects, please click the subscribe button, click the notification bell to get notified of future videos. And if you're interested in any sort of assistance or anything, by all means, reach out to us. We're happy to help you with international tax planning, bank accounts, company formations, residencies, citizenships, all those types of things. So let's dive in. All right, so here's what happened. In 2016, during the presidential race, normally it would have been that presidential race was in 2016. So normally what happens is presidential candidates dating back to, I think it was Nixon, have always released their tax returns. So it's not, I guess, technically required, but it is the norm to kind of show off what is going on in their life. And Trump didn't do this. He claimed, there's not much to see. And he also claimed that he was under an audit and therefore he couldn't do it now. It's true that he was under an audit. It's true that he's still under an audit. And the auditor would say, no, that has nothing to do with it. He can release them. It's not a problem. That being said, he decided not to. And so, this was the subject of a lot of speculation and controversy over a period of time of what's in there that he's trying to hide. I don't think that it was especially surprising, at least not to me. I think it's kind of funny when people come and go, oh my gosh, what's in there? It's like, well, what did you expect to find in there? So let's quickly recap what it is that they found. So first of all, out of 10 of the last 15 years, Trump has not paid taxes at all. Not that he hasn't filed taxes, he's just had no tax obligation, right? He's had no tax owing. The last few years he had a $750 tax bill, so super low, right? And they kind of go through what it is that's behind all of this. And really where it comes from is that although he's earned a lot of money in that time, over that 10 or 15 years, it's to the tune of about $1 billion that was in the stuff that I read. So it was about $500 million from his income from The Apprentice, plus about $20 million a year from Trump Tower, plus about another $10 million a year from some other properties that he owns. So in spite of $1 billion in profit, he has not paid tax or hardly paid any tax, right? So how did he do that? Well, basically the flip side of it is that it appears that a bunch of his businesses, his golf courses in Scotland, Ireland, Washington Hotel, his main operating company and one other have had really massive losses. And so those massive losses, as well as tax losses from previous time, have basically carried forward to his not having any tax obligations. And there's kind of some tricky things around, they'll say, well, he claimed this big $100 million, he claimed a $72 million, I guess it was, tax refund around 2009, I think it was. So basically Obama passed some rules that allowed him to carry back losses, or carry forward losses rather, in a way that he hadn't been able to before. And so, there's a variety of different things that he's done. And so in this whole thing, there's a variety of controversies that people are, if they're anti-Trumpers, upset about, and then there's people who are pro-Trump who have, you have confirmation biases on both sides, right? And so it's a little bit delusional. What I wanted to do was kind of take a few moments to kind of explain some of the pieces that I've been hanging out on Twitter and reading people's comments, which are kind of asinine to me. And I wanted to explain some of these pieces, how they work, how they may be relevant to you. Note that Trump is not using international tax structures to achieve this, okay? The majority of how he's achieving this comes through the fact that he's dealing with real estate. And real estate is it has huge advantages in terms of tax treatment. There's also something he's taken advantage of called conservation easements. And we're going to talk about how that works as well, okay? So let's dive into it. All right, so first of all, it's funny to me because I'll read these things where people are saying, he's a cheat, he's gaming the system, he's whatever. Well, no, it's possible that he's lying on his tax returns. I think that's pretty unlikely. And the reason is, do you actually think that Trump sits there doing his own tax returns? Like the nature of Trump, it's just unlikely that that's the case, right? So he's going to have some pretty expensive tax attorneys, some pretty expensive tax accountants, and so he's going to be using that to, sorry, how about itchy nose there? Anyway, he's going to be using that stuff to go and to maximize his deductions, his losses, but he's not going to be the one figuring this out. He's not going to be like, oh, I had $100 million loss and writing that down, because he's not writing his own stuff down. That's just the reality, right? So I think that so one of the arguments is that he took this $72 million tax refund in 2009 or whatever, and has been maybe slightly after, whatever the date was, right? And has been for the last number of years involved in this lengthy audit and battle with the IRS over this. And so the argument in the New York Times was, well, he may have to pay this back, this $72 million, maybe he shouldn't have gotten it. And then there'd be interest, and so that would be $100 million that he owes. And all the people who are anti-Trump are like, oh, Trump owes $100 million, he's nearly bankrupt. And of course, the article is saying that here's the signs of this guy who's bleeding cash and all this, and we're going to get into that in a minute. I think, first of all, you have to understand that any time you claim a very major loss or deduction like that, you're opening yourself up to an audit. Like, it's just very logical, right? That would be the type of thing they would scrutinize. So I don't find the fact that they're auditing that to be particularly surprising. I also don't find the fact that he's fighting it to be particularly surprising. That's pretty normal, okay? I also find it highly unlikely that it's a completely fabricated deduction. Like I said, his accountants and attorneys, unlikely that would be the case. That would be something totally, like there's hyperbole, which Trump is very known for, and then there's total, just complete and utter fabrication, which Trump is not really known for, right? So in that sense, I think it's possible that they say, hey, listen, you can't carry forward as much loss. You can't reclaim as much of that tax. That's possible, right? But it's unlikely that it would be all of it, and there'd be a negotiation that would take place in there. So, for people who are saying, oh my gosh, he could owe $100 million, it's highly unlikely that he would owe $100 million. Maybe he would owe a portion of that, maybe. Nobody's in a position to say, right? I find it funny that there's all these Twitter keyboard warriors out there who suddenly act like they know what they're talking about because they read a New York Times article when really they don't have a clue, okay? So who knows? That'll be figured out by the IRS. We'll see, right? That'll affect however. But the important thing to note that some people seem not to realize is they're like, hey, why can you, I read somebody's comment, they're like, why are you allowed to write off deductions or to deduct losses anyway? It's like, what? Why are you allowed to deduct losses anyway? Well, it's pretty reasonable because you lose money, When you lose money, then, so that money had to come from somewhere. It makes sense that you're going to want to encourage investment. And so I guess there's two sides to it. Why do we have deductions? Because I'll hear people, this is a really common thing. I think I talked about it before. Amazon had no tax in UK, and they're like, oh my gosh, Amazon made $500 million in UK, but didn't pay any tax. It's like, yeah, but Amazon had no profit there. So you can't get blood from a stone. There is no moral justification for taxing someone if they didn't earn any profit, right? It would be like saying, hey, I'm going to hypothetically pay you a wage. I'm going to give you money that you're going to have to give back to me. I'm giving you a loan or something, and I'm going to tax you on it, right? It would just make no sense. So, of course, we only get taxed on, now, actually I shouldn't say this, most cases we only get taxed on profit. There are actually a few countries, Belize has a regime, Brazil has a regime. There's a few different countries that do have regimes where they can tax you on your revenue. There's something that can happen in Hungary. There's something that can happen in Romania. So there are some examples of cases where basically you have the choice. You can go one way or the other, right? So bottom line is, please be aware, first of all, you get taxed on profit, meaning revenue less expenses, rather than on the revenue, right? That's the first thing. Second of all, Within that, it's not actually quite so clear as what money you really have left over. So let's use a real example here. So I'm from Canada. In Canada, you can write off certain business expenses. So for instance, you could write off meals, but you can't do 100% write-off on a meal. You can only write off half of a meal, okay? So technically, you could have lost money and still have to pay tax because your real cash balance at the end doesn't necessarily match your tax balance at the end. Does this make sense? So for instance, let's say you made $1,000 and then you go out for a meal and let's say you go out for a bunch of meals, right? You're courting a customer to get them. And so over the course of that time, you spend $500 on food, okay? So at the end, you have $500 of profit, right? So you should be taxed on $500 of profit. No, wrong. You're taxed on $750 of profit because you're only allowed to have a 50% deduction on that meal. Okay, that's how it works. Now, that's not true everywhere. Sometimes if you're traveling, then it's a different treatment than if you're at home. If you're in Hong Kong, they allow a full deduction, whereas they don't say in Canada. It depends place to place. Some places you need to have good receipts, some places you don't, et cetera, all right? So that's the first thing. Now, the important part here is it would be very normal that a business in, say, the first few years of operation would lose money, right? This is a normal thing. And so what they allow is, in that time, not only did you not make profit, you lost money, right? You're sinking money in. So what do they allow? They allow you to carry forward deductions. And how long you're allowed to carry it forward for, things like this, depend a lot on the country, depending on the rules, et cetera. But they'll allow you to carry them forward. Meaning that if, say you go in the first year, you lose, I don't know, $1 million, right? Then the next year, you make $1 million. Well, you can carry that $1 million loss forward to write off your gain in this year, so you end up paying nothing in both years, right? Now, this is fair because in reality, you made nothing, right? That's the whole concept. The whole concept is, well, if you made nothing, even if it was like, why do we arbitrarily choose this period of time, which is a year, right? Some people ask, like, why are you allowed to carry forward losses? Like, well, why do you arbitrarily cut off the period where you're making or earning, making profit or loss as a calendar year, right? Or a fiscal year? It doesn't necessarily make any sense, but it's the way that we've made the rules. And so it's kind of fair to do this, and it encourages investment. So I think it's a very important thing. We actually do have that rule, okay? Now, next we'll move into the next part, which is there is a very favorable tax treatment for real estate, okay? So in particular, the thing in real estate is there's a few different things. One is you get to defer, and you can defer basically perpetually, especially in the US where you have 1031 exchanges and things like this. Meaning that the value of the property could go up for a long time, you could keep remortgaging it, pulling cash out, and you spend that cash even, and you're not taxable until you sell the asset at the end. Okay, so that's a very important thing, and you get to write off the interest too. Fantastic. In addition to that though, you also get to depreciate. You have to have depreciation on the property. Now, realistically, the way the depreciation is structured probably isn't very reasonable for real estate. Like, real estate really does have tax advantages to it. You get to see this in Australia too. It's really common that it probably shouldn't, right? Like in reality, I don't think that the industry that you are in should confer tax advantages on it over another. Like, if you made your money online versus in real estate, why should you have better tax treatment in real estate than online, right? Because that's basically what's happening within the tax code. So from that standpoint, and you can look, like, say, Robert Kiyosaki will say, hey, the rich don't pay tax, right? This kind of concept of, well, why is that? It's because of these things, right? They can go and they can make these deductions. And the deductions kind of make sense, right? Or the depreciation rather, because you say, okay, well, let's say a few years ago, I redid my roof, right? On my house that I had at the time. And, the roof is going to last you what, like, I don't know, 20 years, 30 years, something like that. So what they're saying is they're allowing you, when you buy that property, to write it off over a period of time, right? Same thing with, your hot water tank, same thing with whatever. Now the reality though is that typically they're writing these things off over 20 or 30 years, and they're doing that for a portion of the property that you're not actually replacing, right? Like, when do you replace the foundation of your house? Pretty much never. When are you replacing the windows? Almost never. When are you replacing the walls? Pretty much never, right? So to me, it's an example of where the rules have been made in a way that favor real estate owners. It probably shouldn't. It doesn't make sense. you probably should be in a situation where you have to pay tax and you just get write-offs maybe as you do it. So for instance, in the year that I redid my roof or shingled it, that I would take I don't know what it was, $10,000 or something, and I would get to write off the $10,000 against the rent, like something like that. That would make sense. But being able to depreciate it, not so reasonable. But that's a problem with the tax code. And that's something that Trump gets to benefit from. Trump gets to benefit from the fact that he's a real estate developer. And this comes to kind of a next point, which is, a lot of people are like, oh, hey, Trump has $300 million of debt coming due, right? There's something. And it's like, well, hang on a minute. The guy's a real estate developer. How do you think real estate development works? Real estate development works by getting a lot of debt. Okay, everybody in the real estate game, like everybody in the real estate game, carries an enormous amount of debt. That is how that industry works. The returns just aren't that attractive otherwise. That's just the nature of it. Now, I actually should qualify that because I do know a few very good investors in real estate who don't use debt and still do pretty well, but they are few and far between. Like basically, when you have a real estate developer coming in and saying, hey, I'm running for president, and I'm very rich, I have billions of dollars net worth, like it should just be obvious. Of course, he's carrying a ton of debt. Of course he is. That's what you do in that industry. So the fact that this is a surprise is kind of weird to me. And then they're like, oh, well, it's $300 million of personally guaranteed debt. This means nothing outside of assets, okay? So I saw some people saying, oh, he lied, he's not really a billionaire. Well, this doesn't say that he's not a billionaire. Billionaire is about net worth. And without understanding the asset value relative to those loans, you don't know anything. Right? So let's use an example. I think it was he put like $150 million into, or he bought for something like that, this golf course in whatever it was, Scotland or Ireland or whatever. And so he owes, a bunch of money on there. Okay, well, hypothetically, he's raised the value of that property. That property is now, I don't know what it's worth. Who knows, right? Could be whatever. Could be worth 300 million. Could be worth less, right? Who knows? But the point is, if you have if he's doing debt service payments on this, now it's not necessarily clear that that's what's happening, but it would be likely that he'd be making some sort of service payments, which is probably part of where the losses are coming from, right? Is the interest loss. So okay, he's making mortgage payments on it, great, for 10 years. He's paying down the principal. He's probably got a few $100 million worth of equity just in his golf courses, right? Then he's got Trump Tower, then he's got, Mar-a-Lago, then, whatever. So his asset base is probably, it would almost certainly have to be in the billions, okay? And part of the thing that you can understand here is, look, it's not like he has some magic loophole where he's just borrowing from people. Like there's this idea of it's like, oh, he rips off his lenders, he doesn't pay them. It's like, well, hang on a minute. Who do you think these lenders are? These lenders are major banks. They're commercial institutions. They're private lenders. And they have their own due diligence process that they go through to find out that they deemed a loan to be safe. And they have their margin of safety. They say, okay, great, the property is worth X and there's X amount of income and we can cover it. And so if something goes wrong, we're going to reclaim the property. Don't worry about those guys. They're fine, okay? Like stiffing the banks is the last thing you have to worry about. They'll take it back and they'll do what they do. They're very good at their business. I wouldn't worry about that in the least. So it's quite funny to me because he quite likely does have, billions of dollars of net worth. I don't know what it would be, right? You add up his brand, you add up his various companies, you add up his assets. He's probably got, a few $1 billion anyway in assets. Obviously, Forbes has released a list for many years, and they, do pretty thorough research. And I think they were saying he was worth like $2 billion or something. He claimed he was $10 billion. I'll probably go with Forbes, right? But anyway, who knows? So that part is kind of weird. Next is deductions. Like they were saying, okay, he had spent $70,000 on haircuts or hairstyling, right? And people were freaking out about this. Like, oh, you can write this off. It's like, well, you have to consider he's a celebrity star of a reality TV show. So if you're going in to do episodes of this thing, doing filming, etc., how many days are you filming for? This show ran for years and years, right? I don't know how many days they would spend filming, but probably quite a few, right? So say you're filming for, let's say that it costs you $100 each time. right? Which would not be an unreasonable cost for like a celebrity. I mean, you could have $500 being spent on a hairstyling or whatever. So say it was 100 though, then it would say that 700 days somebody worked to style his hair. Would that be reasonable for a show that ran for many, many seasons? Probably. It's not really that surprising. Of course, he's going to write off flights on his private jet, of course. All these things. This is just perfectly normal things, and not really, there's some idea that, oh, Trump somehow is this malicious. It's kind of like people took this narrative where like Trump is a bad guy, Trump is a shyster, Trump is whatever, which might be true, right? Who knows? Obviously, Trump exaggerates lots and says all kinds of different stuff. But the bigger thing is, then they go and they take that and they say, oh, yeah, other people do this, but Trump's a shyster, so when he's doing it illicitly. No, probably not. Again, like I said, he's using reputable accountants, reputable lawyers, etc. They're going and taking care of this for him. They're going to maximize it for him, of course. That's their job. He probably has really good people, So anyway, that's kind of the next thing. The last thing is, there's, I guess, two last things that kind of came out of this. The one is he ended up donating some property, and there was one, I don't remember where it was, but quite an impressive property, and he wanted to do some development on it, couldn't, and so he donated it in what's called a conservation easement. Okay, and this is actually a pretty normal tax strategy. We've worked with some clients who've done this in the past in the U.S., and so basically the idea is you set aside some property for conservation purposes, and you end up getting a tax credit for it. And kind of the beauty of it from Trump's standpoint, supposedly, obviously you don't know without diving into the details, but is that I think he paid like $2.6 million for this one property, and then turned around and you don't know what the actual numbers are, but it's claimed that he got a $26 million tax credit for it. And basically what he did was he went and he looked for different parties that could give him some sort of a different zoning approach to increase the valuation. So if you can do that, that's a way to realize a ton of tax savings, right? So a conservation easement isn't that exciting if you put in $1 million and then you save $1 million in tax. You're like, well, hang on, what did I gain here? I gained nothing, right? But if you can somehow scale it up several times, and there's companies that just this is what they specialize in, right? There's all kinds of different fancy ways that this happens, and there's 501c3 charitable donations and things like this, all kinds of different things that you can do within the bounds of the law to basically try and shift it, try and basically get yourself tax credits to reduce your taxable income payable. Okay, so it's a fully legitimate strategy. It's something that is very well known, used by a lot of people. Should it be there? Probably not, right? It's probably an unreasonable and pretty crazy standard, pretty crazy way to go, right? But that's the reality, is that it's there. The last thing, I guess, is seeing a lot of comments criticizing the fact that they say there were some deductions from income he had earned at Azerbaijan hotel, I think the Vancouver hotel. Basically, he'd licensed his name on a bunch of properties around the world, and I think in the Philippines, a bunch of other places. And so there was a bunch of expenses that were paid out from this income, reducing the taxable income, okay? And the belief was that it seems to be that these fees were paid out as consulting fees to his daughter and or other family members, right? And so people are all up in arms. Oh my gosh, this horrible thing, and of course, they're relying on the New York Times article, which is highly biased, and let's face it, New York Times writers just don't really know that much about taxes or business or wealth building, right? So, first of all, is it a problem to employ your children? No, it's not intrinsically a problem. You can perfectly well employ your children. Okay, that's perfectly fine. Are his children legitimately within his company really doing real work? Yes, absolutely. They're out there doing PR, they're out there doing deals, etc. This is not a fake thing, okay? Next, can you pay somebody whatever you want? Yes, but not if it's a non-arm's length transaction. Okay, so this is the thing that gets a little bit tricky. I saw somebody say, you can't pay somebody more than market rate. Yes, you can. I can go and pay you whatever I want. Like if I think that your services are worth 10 times the market rate, as an independent business owner, I can do that. Now you're gonna have to pay taxes on your end, right? So that's part of the reason why they allow this. But they are not in the business, like the tax department is not here to tell you how much you can spend on how much business expenses are worth to you. You know, if you think that, hey, I want to allocate 90% of my budget to marketing, I can do that. If I want to spend 90% of my budget on, I don't know, administrative expenses, I can do that. That's hurting me. So I have no incentive to do that, right? So then they say, okay, great. Well, the concern is this is an arm's length transaction, or a non-arm's length transaction, sorry, potentially. And it's paid out to his daughter, therefore it might be him trying to get around inheritance taxes. Now, I mean, whether he's trying to get around inheritance taxes or not, I think there's lots of reasons why you can say, hey, listen, of course your company would want to pay some family member of yours money, and that's, you know, a way of giving them money. Like it would be a normal thing. But let's talk about the value that they're providing. Okay, so first of all, like, okay, let's look at Ivanka Trump. Ivanka Trump has her own major brands. She's a public celebrity. She's clearly a very capable woman. She has lots going on for her. What is a reasonable income for somebody like that to earn? Okay, she may have been involved in helping to set up the deals and close the deals to begin with. So let's say that I was to go and I was to make a deal with the Trump organization, right? I was to say, hey, listen, if I bring you customers, I want a certain percentage of the royalties. Whatever you charge in licensing fees for the next, however long, when I bring the customer, I want 10%. Would that be a reasonable thing? Probably it would. Like so long as I can get them to agree to that. And I think that's like, otherwise they wouldn't have the deal, you know, like that's just it. Like I bring you the sales, I get the percentage, that's that. You can go and you can say, okay, what's the fair market rate? You'd have to compare it around. But the idea that she got a few $1 million paid out over several years on this is not a crazy number. Like I feel as though the people they just have no sense of the numbers that you're talking about when you're talking about big deals. They don't think about, hey, listen, like Trump, for his role in The Apprentice, like his share of profits, et cetera, was like $500 million, right? So what do you think Mark Burnett made? What do you think the writers made? What do you think, like, just run down the list. People make a lot of money. There's a lot of fees paid on this. She's not getting $100,000 being who she is. It's just not the way that it goes. Like and so I don't particularly find it crazy, even if there was like, okay, they slightly overstated it or whatever. It's like, it's a wash, right? And what are you talking about? Like, of course you're going to give stuff to your kids. Of course you will. What are we talking about here? Honestly, it doesn't even really change the tax consequences. Whether you pay them, the only thing that would be changing is if you were avoiding inheritance tax versus regular earned income tax. She's going to pay her own income tax on it. So anyway, the whole thing I think is quite funny. Hopefully this kind of settles a few senses. Hopefully it also gives you some insight into the fact that, you know what, like there's a lot of good tax planning that you can do out there. Like there is some crazy stuff, and we're not saying that that's a good thing or a bad thing, you know, but the reality is there's lots of ways to game the system. I don't want to call it game the system. There are lots of, like, the system is not set up evenly. And so if you understand where the levers are to pull, you can do some really good tax planning, even in some high tax places. So anyway, hope that helps. If you're interested in learning more, please click the subscribe button. There's a link below if you want to book a call with me, clarity.fm/Michael Rosmer. You can check out our websites, offshorecitizen.net, offshorecapitalist.com. Click the like button, share this video with friends, and I'm going to see you guys on the next video.